Most people build their portfolio the wrong way. They buy whatever is trending. They chase yield. They jump between funds every time the market gets nervous. And after years of doing that, they end up with a bloated, confusing mess of positions they can barely explain, generating less income than they expected and less growth than they needed. And that mess has a cost. The average American household has around $334,000 saved for retirement. That's the result of decades of working, decades of saving, decades of trying to do the right thing with money. And $334,000 sounds like a lot until you actually try to live off it. At a 4% safe withdrawal rate, that's around $13,360 a year. That's $1,113 a month. That is not financial freedom. That is barely survival. But here's what changes everything. What if the smartest portfolio you could build isn't the most complicated one? What if it's just 4 ETFs, one to anchor your money, one to grow it fast, one to pay you consistently, and one to compound that income faster than anything else in the market? In this video, I'm going to show you exactly how to build that portfolio, even if you're starting with just $10 a day. We'll look at how each ETF performs on its own, then combine all 4 into a single portfolio. And by the end, I'll show you how that portfolio could turn $10,000 into well over $500,000, and how that same portfolio could turn just $10 a day into over $1 million. But first, before you put a single dollar anywhere, there are 3 rules you need to know. Rule 1. 1 ETF per job. Each of the 4 ETFs in this portfolio has a specific role to play. Doubling up doesn't make the portfolio stronger. It makes it messier and more expensive. 1 fund per job. Keep it clean. Rule 2. Know your timeline. This portfolio works differently depending on where you are in life. If you're in your 20s or 30s, time is your biggest asset, and you can lean harder into growth. If you're closer to needing the income, stability and yield matter more right now. There's no wrong answer, but you need to know which version of yourself you're building for before you start. Rule 3. Stay consistent. The best 4 ETFs in the world generate nothing if you panic out at the first sign of a downturn. Reinvest the dividends. Don't react to the headlines. Let time do what it does when you don't get in its way. Those are the 3 rules. Now let's talk about the portfolio. ETF number 1, VTI, the anchor. Every serious portfolio needs something at its core that holds the line no matter what the market throws at it. Not the fastest grower, not the highest yielder, just something broad, cheap, and built to last through anything. That's the job of VTI, the Vanguard Total Stock Market ETF. VTI owns the entire American stock market, over 3,600 companies in a single fund. When you buy VTI, you're not making a bet on any one sector or any one company. You're making a bet on the American economy as a whole. And historically, that has been one of the most reliable long-term bets any investor can make. When tech pulls back, healthcare carries the weight. When consumer stocks struggle, industrials and financials pick up the slack. The whole market balances itself out over time, and you are along for the entire ride without having to pick winners. VTI also has the lowest expense ratio of the 4 funds in this portfolio, at just 0.03%. That means for every $10,000 you invest, you pay $3 a year in fees. $3. That's what it costs to own the entire American stock market. VTI's 10-year annualized return with dividends reinvested is 14.98%. The current dividend yield sits at 1.07%, with dividends paid quarterly. So what does that actually look like in your pocket? Put $10,000 into VTI today, reinvest every dividend, and after 1 year, that's projected to grow to around $11,498. Give it 10 years, and that $10,000 could be worth around $40,000. By year 20, you're looking at approximately $160,000. And by year 30, that single $10,000 investment is projected to reach around $641,000. That is your anchor. building wealth in the background, steady and silent, while the rest of the portfolio does its specialized jobs around it. Market beat. ETF number 2, QQQM, the growth engine. The anchor keeps you stable, but stable alone won't make you wealthy fast enough. You need something in this portfolio that's built specifically to grow your money as aggressively as the market allows. That's QQQM, the Invesco NASDAQ 100 ETF. QQQM tracks the 100 largest non-financial companies on the NASDAQ: NVIDIA, Apple, Micron, Microsoft, Amazon. About 53% technology. These aren't speculative startups hoping to figure things out one day. These are the most profitable, cash-rich, dominant businesses on the planet right now, and they all happen to be listed on the same exchange. QQQM is not an income fund. The dividend yield is just 0.45%. Don't buy this fund for the check it sends you. Buy it for what the share price does over time. The 5-year total return for QQQM is 112.10%, meaning $1,000 invested 5 years ago would be worth over $2,120 today. Since inception in October 2020, QQQM has delivered a total return of over 151%, averaging around 17.6% per year. The expense ratio is 0.15%, still dirt cheap by any standard. Seeking alpha, invest lane. What does that look like in your pocket? Put $10,000 into QQQM today and reinvest dividends. After 1 year, the projection puts you at around $11,660. After 10 years, that climbs to approximately $50,000. By year 20, you're sitting at around $250,000. And at year 30, using the historical annualized return, that single $10,000 investment is projected to reach approximately $250,000. That is your growth engine. Given enough time, this is the fund that does the heaviest lifting on total portfolio value. But growth alone doesn't pay your bills while you're waiting for it. That's where the next 2 ETFs come in. ETF number 3, SCHD, the paycheck. There is a question every dividend investor eventually has to answer. What am I actually getting paid while I wait for the growth to compound? VTI pays a little. QQQM pays almost nothing. You need a fund whose entire purpose is to send you a growing check every single quarter, no matter what the market is doing. That's SCHD, the Schwab U.S. Dividend Equity ETF. SCHD screens for companies with strong balance sheets, a track record of consistent dividend payments, and the financial strength to keep raising those payouts even when the economy gets difficult. What you end up with is a portfolio of battle-tested businesses: Qualcomm, Coca-Cola, Texas Instruments, Bristol-Myers Squibb, companies that generate real cash and share it with shareholders year after year without fail. SCHD currently has a dividend yield of 3.27%, the highest of any fund in this portfolio. The 10-year dividend CAGR is 13.54%, with around 9.27% share price appreciation annually. The expense ratio is just 0.06%. So what does that look like in your pocket? Put $10,000 into SCHD today and reinvest every dividend. And after 1 year, you're projected to be around $11,254. After 10 years, that $10,000 could be worth approximately $34,000. By year 20, you're looking at around $115,000. And at year 30, that $10,000 is projected to grow to around $392,000, with roughly $1,064 landing in your account every single month in dividend income by that point. That's $12,768 a year in passive income from one ETF alone. That is your paycheck, the fund that keeps depositing income into your account, whether you're watching or not. Yahoo Finance, Finvest. ETF number 4, DGRO, the compounder. This is the one most people don't talk about enough, and it might be the most important fund in the entire portfolio, not because of what it pays you today, because of what it's engineered to pay you tomorrow. That's DGRO, the iShares Core Dividend Growth ETF from BlackRock. To get into DGRO, a company must have grown their dividend for at least 5 consecutive years and maintain a payout ratio under 75%. That filter does something most people miss. It automatically removes dividend traps, companies paying unsustainably high yields they can't maintain. It removes struggling businesses that cut dividends the moment things get hard. What's left is a portfolio of financially disciplined companies across financials, healthcare, and technology that have proven they can grow their income year after year through full market cycles. The 10-year average annual return for DGRO is 13.26%. The trailing yield currently sits at around 1.92%, with a 5-year dividend growth rate of 9.2% per year. The expense ratio is 0.08.
And here's the number that makes DGRO the sleeper of this portfolio. That 9.2% dividend growth rate compounding on itself year after year means the income DGRO pays in year 20 is dramatically higher than what it pays in year 1. Low yield today, rapidly accelerating income tomorrow. That's the compounder at work. What does that look like in your pocket? Put $10,000 into DGRO today and reinvest every dividend. After 1 year, you're projected at around $11,326. After 10 years, that grows to approximately $35,000. By year 20, you're looking at around $122,000. And by year 30, that original $10,000 is projected to grow to approximately $571,000, with around $720 landing in your account every single month in dividend income. That's $9,600 a year in passive income from one $10,000 investment left alone for 30 years. Remember that $334,000 average retirement savings figure from the beginning? This portfolio beats it by over $237,000 from a single one-time investment with nothing added after that. And matching the average was never the point. But what if you don't have $10,000 sitting around right now? What if that kind of lump sum isn't on the table? Here's where this gets really interesting, because this same portfolio works just as well with something far more accessible. $10 a day. No windfall, no lump sum, no perfect moment. Just $10 a day invested consistently across these 4 ETFs with dividends reinvested automatically. By the end of year 1, you'd have put in $3,650. That sets the foundation. By year 10, that daily habit is projected to be worth around $74,200. By year 20, you're looking at approximately $358,000. And by year 30, that $10 a day is projected to grow into over $1,400,000. Over $1 million from a daily coffee budget. By that point, the portfolio could be paying you around $1,980 every single month in dividend income. That's $23,600 a year landing in your account passively. Over the full 30 years, you'd have put in around $109,500 in total. The portfolio builds the rest. That $334,000 average retirement savings number? With just $10 a day in these 4 ETFs, this portfolio is projected to hit 4 times that figure and then some. 4 funds, 4 jobs. One portfolio that works whether you're starting with $10,000 today or building from $10 a day. The complexity was never what made the difference. The consistency is what makes the difference. And now you know exactly what to be consistent with. If you want to see how this portfolio performs when you add just one more ETF and what that does to the income number at year 30, that video is on screen right now.